Good morning and welcome to the Spheria Emerging Companies Shareholders Conference. Your hosts today are Adrian Whittingham, Director of the company, and Matthew Booker and Marcus Burns, Portfolio Managers of Spheria Asset Managers. Go ahead. Thank you.
Good morning and welcome to shareholders of Spheria Emerging Companies. This is the first half conference call covering the half-year results and also a portfolio update. As has been introduced, my name is Adrian Whittingham and I am a director of the company, and joining me this morning are co-founders and joint portfolio managers of Spheria Asset Management, Matthew Booker and Marcus Burns. I will note that the presentation is available on the ASX as well as on the company website. Moving to the results on page 3, the company reported a loss of $9.2 million for the first half, reflecting the challenging conditions for the small company sector. The company declined by 10.7% for the first half. However, it did outperform the benchmark by 2%, reflecting the more conservative cash flow approach of the Spheria investment team. The board resolved to pay an interim dividend of 2 cents. When you combine that with the 4-cent final dividend in the second half of 2018, 6 cents of dividends have now been paid to shareholders over the last 12 months. I'd now like to move to page 4, which shows the NTA breakdown for the company. As you can see, the pre-tax NTA as at 31st of December was $1.84, down from $2.10 at the start of the period, again reflecting the environment I talked to earlier. Pleasingly, we have seen the pre-tax NTA increase back above the listing price to $2.017 as at the 22nd of February 2019. And as Marcus and Matthew will talk to, the environment has been more positive for smaller companies in recent times. I'd now like to move to page 5. Shareholders will receive the interim dividend of 2 cents to be paid on the 20th of March 2019. And I'd also like to point to the market capitalisation of the company as at 31 December 2018 of $114.1 million. The company is still young, and during the period we've seen the discount to NTA narrow and more recently widen again. The company is focused on ensuring we engage shareholders to work towards narrowing this discount. And for example, Spheria Asset Management, the investment manager, purchased shares in SEC during the half, reflecting their confidence in the company and also the valuation discount that is apparent. The company aims to pay fully franked dividends from the portfolio income at least annually, subject to available profits, cash flow and franking credits. I would now like for us to move to page 6 and hand over the call to Marcus and Matthew to discuss the performance.
Thanks, Adrian. It's Marcus Burns here, the co-founder of Spheria. Just quickly on the top of page 6, you can see the performance there of the mandate or the portfolio, if you like, over a period of time since we incepted the company. And the key thing to note there is that obviously the back half of last year was more challenging for the stock market. Particular smaller companies were sold off. As Adrian highlighted earlier, we have a big focus on fundamentals with our approach. So we look at cash flows, valuations and balance sheets, and that really forms the bedrock of what we do. And so we typically expect the companies to do better in a tougher environment. And indeed that was the case where our stocks held up better than the average in the small ordinaries index. And that's pleasing to see for us and the kind of style of investment we make. So since inception, the portfolio has outperformed post fees by 1.7%, which is reasonably pleasing for us. The second table on page 6, the bottom one there, just looking at the NTA performance, compares the company's post-tax returns against the index, which is pre-tax. it's a very harsh comparison. But even since that period of time, the NTA post-tax has actually outperformed the benchmark. So we're pleased with that recent performance of the fund.
Just moving on to slide 7, we'll just go through some examples. And the first one is Navitas, and you'll see these charts from us. Pretty much they'll be in every document that we do, any presentation that we do. And the top left chart just shows the cash flow of Navitas, and that is the dark blue lines historically versus the actual earnings which they produce. And you can see this company's been a strong cash flow producer for a number of years. It is a very sustainable business. It's the largest global operator of university pathway programs in the world. What we saw basically last year is it became a takeover target at $5.50, so it's a company we've owned in the funds for a long time, and obviously we bought it in the LIC. And obviously we weren't happy with the actual takeover price, but the board has managed to achieve a better price. So they've lifted that price to $582.5, and they've engaged with the takeover suitor. So we suspect that there's more water to flow under the bridge in this one, and there may be other parties interested in acquiring it. But at $582.5, we're relatively happy with the price at that level. Just moving on to the next slide, which is slide 8. Marcus will talk through trademe.
Thanks, Matt. Yeah, so another stock we held in the fund, and the company, was trademe, which is a New Zealand stock. It's basically effectively a combination of the eBay of New Zealand, along with a bunch of classified businesses that effectively replicate what car sales and realestate.com and Seek do in Australia. So it's a combination of those two businesses. What I think there's two interesting facts on this stock that we found appealing. Again, on the left-hand side there, you can see the cash flow conversion chart. This is on page 8, sorry, just to clarify. As Matt said before, we look at the cash flow conversion in all the stocks we invest in the fund, and we're looking for that high cash flow. So in other words, we're looking for a quality of earnings where cash closely matches the accounting reported earnings, and that becomes more appealing for us because it's easy to value, and cash generated by companies can be redeployed to pay dividends or buy back stock in tough times. So trademe had excellent cash flow conversion for a long period of time. But interestingly, the chart on the right-hand side just shows you the growth in the classified side of the business, which is the Seek, realestate.com, and car sales equivalent over there, where they basically dominate those verticals. And when the business listed 4 or 5 years ago, the slower-growing eBay side, if you like, was dominating in terms of the earnings and the returns of the company. And more recently, as the classifieds are growing, they're adding a lot more growth to the business over time, and I think that's really what made it more appealing for us. In late November last year, it got two takeover offers from venture capital funds overseas, and ultimately Apex Partners out of the UK paid a higher price of $6.45 and secured that takeover. So that's been a nice win for the company.
Just moving on to slide 9. So we've had a couple of takeovers. We've had companies where the share prices have performed well. We do own a big position in a company called CLAS, and we think it's a fantastic business, but the share price has retraced pretty significantly over the past 18 months, but we think that is the opportunity. You can see the chart there in terms of cash flow conversion for the business. It's a fantastic cash flow business. It has 28%, it's a software business, and has 28% of the market that it operates in, which is self-managed super funds. It is moving into an adjacency in family trusts, and there's broader uses for the product as well, we think, through the wealth management market. Now, looking at this business, they have 170,000 odd accounts on their system. The accounts pay them $220 per year. So it's a very predictable, very visible revenue stream, and the customer retention rate is over 99%. Now, this company is trading at a value multiple, so it's trading about 10 times EBIT, and we think at that price it's being given away. So a very good business. Share price hasn't performed, but we believe that there'll be significant upside in this business over the next few years.
Yeah, that's a good point. And just to finish off with some highlights and some observations we'll make on the small cap market. We've seen a very interesting, obviously, bounce back in the small companies sector over the last 2 months. And what you've really seen is that the top end, the momentum style businesses have had a massive re-rating again. So some of the technology names have really recovered from those lows in December last year. Thankfully, actually the company's performing very well, and we've kept up with that retracement back up again. What we're finding though is that amongst that some malaise and sell-off, we're finding that the smaller cap end, micro caps have become very cheap. In addition to that, some of the cyclical names in the economy, so some of the retailers, some of the housing-related stocks, a couple of retailers and some media names have become quite cheap again. So we're looking potentially at investing more of the portfolio into cyclical names where we're seeing increasingly better relative values. But just to remind you, we've had a lot of benefit from takeover activity in the last 12 months. That's likely to continue. We don't specifically seek takeover, that's not the main thesis for our investment in these companies, but because most of them produce very good cash flow, most of them have attractive valuations and pretty solid balance sheets. They're the kind of stocks that private equity and corporates are looking to take over, and we've been a very high beneficiary of that, and I suspect that will be the case looking forward. So in the medium term, as I said, we think that the portfolio will start to skew towards some more cyclical names gently as we find valuations more appealing, and I suspect that we'll still see takeovers being a pretty central theme in the small companies market for the next 12 to 18 months.
So on slide 11, you can see our top 10 positions in the LIC. There's some interesting names there. At this point, I think it's probably best to open up to questions, and maybe some of these names become a discussion point for that Q&A.
Our first question is from Trevor Hu, and I'll just put him through now. Thank you.
What's your investment thesis on Technology One?
Hi Trevor, thank you. The thesis there is we haven't discussed this a great deal with our investors, but we have a designation of core holding and satellite holding in the funds where we think about our position sizing. So a core holding is a stock that we think meets all our basic criteria and so good valuation, good cash, good balance sheet, etc. Technology One has been a stock that we've looked at for many, many years. IPO'd back in, I think, 1999, so a long time ago. It's got a fantastic history of cash flow generation. If we did those cash flow charts, I showed you those, you'd go back almost 19 years with something like 97, 98% cash flow conversion for almost 19 years, which is incredible. An incredible record, really. One of the best cash conversion histories, I'd say, in Australia. So a bit like Class, the retention rate of the client base is in the high 90s, something like 98, 99%. So once they get a client, they're very sticky. Thesis there really was it's been a holding since we launched the company in late November 2017, sorry. And we increased the weighting materially last year after the first half result when the stock pulled back aggressively on the back of a fairly weak first half because we found the valuation even more appealing. And since then, of course, it's had a good re-rate, mainly because they delivered excellent second half results. And I think people have got to understand the story a lot better. So it was a traditional software seller where it sold a license and a maintenance revenue stream. And what it's doing is migrating the whole business model across to more of a cloud-based SaaS style, more recurring revenue stream. And so you should see going forward that earnings stream become even less volatile and more certain. And so I think really we see that migration being a real positive. We see the client retention being a real positive. And they've gently grown the business out of Australia into the UK, but it's been a sort of a gentle move out of the country rather than an aggressive move out. So the losses have been pretty contained and pretty small. And it looks like the UK will be successful and move into profit this year. So, all that plus a good valuation we found appealing.
Do you think the valuation's a bit lofty at the moment?
Yeah, definitely more stretched than when we bought it. We averaged in at, I think, $4.44 and it's trading at $7.50. So it's had a big run. We have been reducing our holding, but, the long-term prospects for this business are fantastic. As Mark has said, they've got a really strong business here that they're converting clients to the cloud. And if you move to the UK, it's a very, they've been in that market for a long time, but it's a very similar market in terms of structure. So, there's a big addressable market in the UK. This business could be bigger over there than it is here. So, the long-term prospects for the business are fantastic. Yes, the short-term multiple is high, but I think the prospects kind of outweigh that.
Yeah, and to Matt's point, we tend to reduce the weighting a bit when it gets a bit stretched, but we do see intrinsic value growing through time, and so it's going to retain a core holding position in our fund or in the company.
And what about Platinum? I mean, I just note that they've been the kind of main fund has been underperforming for quite 10 years, I think. What's the upside there?
Yeah, Platinum is obviously a high cash flow business. They have, I think, around $25, $26 billion of mostly retail It's fairly sticky, but there is risk around losing money. Their performance has been poor in the past 12 months, and prior to that, they had a bit of outperformance, but they did have an underperformance period a couple of years ago as well. So there is some risk around outflows. However, it's just like any funds management business. They're going to go through cycles where they have good times and bad times. We think their medium to long-term bet on Asia, and particularly China, will play out. You're starting to see that at the moment. The Shanghai index has rebounded significantly in the past few weeks. I think it's up 30% or something like that. Platinum's obviously very exposed to that market, so you could see a strong rebound in terms of performance, and obviously that translates through to funds under management, and therefore translates through to profitability as well. So, look, sentiment can change very quickly for funds management businesses, and we suspect the sentiment could turn pretty positive here.
Okay, great, thank you.
Yeah, sorry, just to finish that one off, the balance sheet's always been their cash, which is crucial to us. The cash flow's been very good, and the valuation certainly isn't stretched. So that's also what we find appealing, as well as the fact that we do think it's a slightly contrarian, investment at the moment.
Okay, great, thank you.
Thanks, Trevor.
Thank you, Trevor. Our next question is from Paul Turnbull. Please go ahead, Paul.
My question was also about asset managers. I was interested in Platinum, but also, how do you see Platinum as it stacks up against some of the alternatives like Magellan, or maybe some of the smaller players too, like Pinnacle?
Yeah, look, I mean, Magellan obviously has had a long bet on the US, and that's worked, perfectly in this market, whereas Platinum's had the other bet, which is China and Asia, which has not worked. Like I said, these things can change pretty quickly, so performance can flick back the other way quickly. We've seen that a number of times with Platinum. Our view is, we were up in China in November last year. We think China will rebound the economy. It's going through a bit of a tough patch at the moment, but I think people that go up there will understand the magnitude and the sophistication of that economy and the growth potential that lies ahead of it. I think it will drive the global economy for many years to come. So we think that bet will play out. Obviously, there's the short to medium term risk that fund flows are negative for Platinum, but in terms of relative comparison, obviously Platinum is a lot cheaper than Magellan. We invest in other asset managers as well, and there are some managers which are cheaper than Platinum, but they tend to be losing a lot of money. So Janus Henderson, for example, is a company that we follow. Its fund flows are very negative, and it's trading at a very low multiple. So Platinum's somewhere in between Magellan and Janus, and we think that the prospects could improve pretty dramatically in the next few months, particularly with the move you've seen in Asia.
Thank you.
Thank you very much, Paul. Our next question is from Alex Rodovostic from DBSS. Please go ahead, Alex.
Hey guys, look, it's obviously been a bit frustrating with the share price trading at a discount to NTA. I just found it interesting how you guys mentioned that even though performance has improved, that the NTA actually ended up widening. Just wanted to get your thoughts on that, and also just on the note that how you guys said as well that you guys bought stock back on market. Is that a policy that's going to keep going on forward if it does trade at a discount, or just wanted to get your thoughts?
Yeah, sure, Alex. Thanks for the question. It's a good one, and obviously it's one that exercises our mind as well. Look, we've not bought stock back, but we've actually, the funds managers, Spheria Asset Management's bought stock in the LIC because we think it's very cheap. We think it's a good opportunity to buy a portfolio cheaply. I guess, my analogy here is it's a bit like any company. So, Matt discussed CLASX before, where fundamentally we think there's an incredibly good business there, good earnings growth, good cash conversion, and yet the share price doesn't reflect what's going on in the fundamentals. I don't know if you tried about this, but we think that the LIC is going through the same thing. It IPO'd, it's going through a bit of a learning process where people work out, what we do, how we think. We're very consistent with our philosophy, and hopefully our communication is clear and consistent and improving. And we think that it will eventually find shareholders that it appeals to. In the meantime, it's trading cheaply, and we think that's a good opportunity to invest further capital. And if you like the strategy and the outcome, we're paying dividends regularly. That's the intent going forward. They're fully franked. We're all fairly materially invested in the shares as well. So it's disappointing, but I think we will find investors over time that recognise what we're doing and the benefits of being exposed long term. But it is short term frustrating. We accept that and we buy into that as well.
Yeah, I think the markets are generally frustrating at the moment. You're seeing a lot of quantitative and momentum type money pushing multiples up for companies that we can't justify. And the flip side of that equation, you're seeing companies like SEC and good quality companies with good cash flow getting discounted aggressively in the market. And we think there'll be a snapback at some point. So we just got to keep doing what we're doing in terms of investing, and if we keep driving that NTA up, eventually the share price will follow. But on that front, Marcus and myself and the team, we always discuss, potentially buying some more stock in SEC. It's always on the agenda, and we'll look to re-enter when we see opportunities. And obviously, that discount has widened at the moment, so we're reviewing that at the moment.
Also, the chairman has recently added to his stake.
Yeah, the chairman recently bought stock in the company, so that again is validation that he believes in what we're doing, and we're all taking long-term views. We reckon that discount will unwind at some point, and we think that the underlying asset value can be driven higher as well.
And the actual total number of shareholders has increased since IPO, and that has been a focus for us, is to broaden out the shareholder base of the company. In particular, we've seen increasing interest from advisory firms who are moving from, say, managed fund to listed or off platform, and they're recognising that they can buy the fund or they can buy the company at a discount. So it's certainly something we're very focused on for shareholders, and we'll continue to work hard to assist in narrowing that discount.
Thanks, guys.
Thank you, Alex. Our final question is from Dale Mark, and he's a private investor. Please go ahead, Dale.
Hi guys. Just wondering, how do you guys differentiate yourselves with others that invest in small caps?
Sure, Dale. Dale, thanks for the question. Look, we hope we think differently. We philosophically, Matt and I and the team, buy into long-term fundamentals driving positive outcomes for investors. So I think what we do, and you might have picked up from the tone, we spend a lot of time in front of the screens doing modelling, models meeting companies. We focus on fundamentals. So our rigorous focus on cash flows, low balance sheet gearing and valuations, I think, do strangely differentiate us from others. We don't chase short-term alpha by buying momentum stocks. I think we feel that a lot of people are crowded into popular names right now at the top of the small cap space. So, Afterpay, App, and I'm not thinking these as being bad companies. I think they're all quite good business. Some are quite good businesses. The valuations have certainly stretched in many of these names, NextDC and others that have had incredible runs, most of which are not justified in valuation terms, in our opinion. We've fortunately found alternative stocks that we think offer better long-term prospects, where valuations are much more supportive. Like in the short term, when rates are very low and you've got quant funds sort of dominating the flow, etc., some of these names perform very strongly, but our view is that in the long run the market's rational. That old Buffett quote about weighing machine and voting machine. In the long run, these names get found out, and cash flows do out. So we focus on that kind of thing. And I think if you looked at our top 10 holdings and compared them to many of our small cap peers, you would see a very, very different portfolio set to what the other guys are offering. And we think that's important to differentiate what we're doing. And certainly in downturns, we perform better in the marketplace. That's been our history. We typically have lower volatility and lower risk metrics on the portfolio. Again, that's been history, and that's where we are today. So that's how I think we offer a different approach. Matt, do you want to?
Yeah, look, I mean, as Marcus said, there's a lot of crowded trades out there where people are just paying higher and higher multiples for the same earning stream, and that's risky. So a lot of these top 10 holdings have the same names, and if you start investing in those ones, if that bubble does pop, the downside could be quite significant. So we try and do things a bit differently. We think we're buying high quality companies at decent multiples, and that over time there'll be proof in the pudding that these companies will outperform, and we've done it for a long time now. So and I think that we'll continue just to do what we do, is just to invest in good cash flow businesses at the right price.
Thanks for that.
Thanks for your question. Yeah, thanks for your question. Good morning.
Thanks so much, Dale. We have no further questions at the moment.
I'd like to remind shareholders that this recording plus the slides will be available next week on the company website. And in wrapping up, I'd certainly like to thank all shareholders for the continued support of the company and look forward to seeing you either at shareholder sessions or on the next call. Thank you very much.
Thank you, everyone. You can now hang up your call.